Welcome to a new episode of FinTalk from BHM Capital. Today's episode is a bit different. In the past episodes, we were talking mainly about capital markets and especially investing in equities. Today, the subject is different because in BHM Capital, we have introduced a new product called fixed income. Our guest today is James Miligan. Welcome, James.
Thank you, man.
James, just to give you a heads up, FinTalk is targeting retail investors. So we want to explain to our audience from the retail investors what is fixed income, and we will start from here. So what is fixed income?
Sure. I mean, as you can tell from the name, I mean, the main characteristics of fixed income instruments are that they give you a fixed return for a defined period of time.
So how is that different from equities, for example?
Well, the main difference, I mean, just to put it in very simple terms, is that if you are an equity holder, a shareholder in a particular company, you own a slice of that particular company. So you would benefit if that price rises, and consequently the adverse reaction if the price falls. Whereas with a fixed income instrument, you're actually making a loan to the issuer, which then needs to be paid back at the maturity of the instrument, but you will receive in return a coupon payment or a profit rate in the event of an Islamic bond for the length of that maturity.
So you're acting as a lender. You're a lender.
As a fixed income bond holder and trader, you are a lender, yes.
And do you make money if the bond price goes up?
Yeah, there are several different factors within fixed income instruments. There's the coupon, so that's a fixed return that you will receive regardless. But then also you are affected by what happens to the interest rate component of that bond. So you could still have a situation, for example, where you get the coupon, but the underlying interest rates have moved against you, and you can end up losing money on the capital price of the instrument, but still receive the coupon.
So in equities, generally speaking, theoretically speaking, prices of equities go up if the performance of the company go up. In the case of fixed income, which is bonds or sukuk, why would I care about the performance of the company? Does the price of the bond increases because of the performance of the issuer, or there is another factor that affects it?
It's twofold. So yes, if the company does well, then you would expect the credit spread to tighten. But as I mentioned before, you could have a situation whereby if it's a fixed bond and it's linked to a movement in interest rates, if interest rates sell off, the underlying US Treasury bond sells off, you could have a situation where the credit spread tightens, but the bond price falls, and the net of those two could still mean that you lose money. Mm-hmm. So there is more than just the one component. But in general, you look at credit spreads tightening based on the positive performance of a particular credit.
Do retail investors invest in bonds?
Absolutely.
How can they do that?
The minimum denomination in general is normally $200,000. So if you have 200,000 or more to invest, then it's very possible to invest in the many different types of bonds that are available.
So in equities, for example, investors go to a brokerage company, open an account, deposit money, and give an order to buy and then sell shares. How does it work in fixed income?
In exactly the same way. They would deposit funds, and provided they have enough funds on their account, then they can invest in fixed income instruments as well.
Are there issuers in the UAE?
There are many in the UAE. I mean, just to give you an example of the universe at the moment, there's about $550 billion equivalent of bonds issued by regional issuers, of which 170 billion is from issuers from the UAE. So there's
like who?
all manner of, we have government, so we have issuance at the federal UAE level, we have Dubai issuance, we have Abu Dhabi issuance, many banks, financial institutions, FAB, EMBD, Mashreq. We also have many corporates, EMAR, Mubadala, Taka, Aldar. There are many issuers and increasing all the time. We had an issue this week for Bengati, who are a first-time issuer to the market. So increasing all the time.
So a company like Bengati, for example, since it's the most recent, why would a company like that issue bonds? Why would they borrow from people?
Well, they have, obviously their model is to as a real estate developer, they have to they would sell off plan, but there would be a lot of costs involved in getting these projects up and running prior to making sales to customers, such as the acquisition of land, advertising, putting together different structures.
But why don't they take loans from the bank?
Well, perhaps they've evaluated the different options, and a bond would be something that would be it's also
No, I mean theoretically speaking, what is the difference for a company when they borrow from the bank or when they borrow from the public through bonds?
Well, they would still require repayment of those, but if it was a one transaction with one bank, then it would tend to be sort of under the radar. If the company want to get their name out there into the marketplace and have people talking about their developments and what they're doing, there's no better way of being able to do that than to sell to many different investors, including retail investors, rather than just one loan from a bank.
Mm-hmm. Correct me if I'm wrong. A loan is usually repaid in equal installments, but a bond loan, the company that issues the bond only pays back coupons, and then after a period of time, like 5 years or 6 years, then they pay the principal amount. Is that correct?
Correct, yes. The coupons can be anywhere from, they can be quarterly, semi-annually, annually, but then the whole of the proceeds, the maturity proceeds, would be paid in one hit at the end of the maturity.
So the investor will be lending the issuer an amount that will not be repaid until a period is done, like a maturity.
Correct. So, for example, just say the minimum denomination was 200,000. So he would be paying 200,000 for that, that transaction to start with. In return, he would be receiving that coupon. 9 5/8 was the yield that bond came at, for example, and they would be receiving that on a regular basis, the coupon.
So here, there is a risk. Me as an investor in shares, for example, when I buy using 1 million dirhams shares of whatever company, the next day or the day after, if the share is liquid, I can easily sell this investment. When I buy bonds, I have to wait for 5 years until I get my principal?
Not at all. There's a very active secondary market now where exactly the same way that you can with shares, you can sell the very next day. I mean, that's our job as market makers.
So it's your option to wait until the maturity or to sell whenever you want?
Absolutely, in exactly the same way as with a share purchase.
All public investors, retail investors, hear about credit rating agencies and credit rating in general. How is that relevant to fixed income?
Well, there are many rating agencies that perform. They have teams of people that evaluate credits, such as Standard & Poor's, Moody's, Fitch, and their job is to really delve into the creditworthiness of these companies. And it just makes it easier because if you're a retail investor that doesn't have the time perhaps to evaluate individual credits, you have faith in the ratings that the agencies give. That's not to say that they aren't wrong. On many occasions, rating agencies have been behind the curve, and it always pays to do your own research, but it just gives people more confidence to invest.
Again, talking about credit rating, if the rating of the bond is higher, like A or B, compared to C or D, how is that affecting the price of the bond?
Well, you would expect logically the higher the rating, the lower the return that the bond would give. I mean, traditionally the best rated bonds out there are issued by, the G3 governments, such as, the US, for example. That's deemed to be the best credit rating of any of the bonds out there that trade. And they're clearly going to give a lower return than a Bengati bond, for example, that we've just spoken about, which
is a private company.
Has a rating of B plus from Fitch. So AAA versus B plus, of course you're going to get paid more for taking Bengati risk than you are for US Treasuries.
Equities are traded in exchanges, so anyone can open the website of DFM, for example, and at any moment you can know the price of Amar. How do you know the prices of the bonds that you have invested in?
That's a very good question. Bonds are obviously OTC, over the counter, rather than traded on an exchange. So we as market makers, if you have bonds held in custody, then we would provide the price of bonds once you own them. But obviously, if you're looking at bonds, we send out price runs first thing in the morning, along with commentary as to what's happened on a macro basis. And we update these price runs maybe 3 or 4 times during the day. So if you're an investor that has expressed an interest in looking at fixed income, then we would, either direct or via a relationship manager, we would provide regular pricing updates. So that's easy to find.
So if I deal, me as an investor, if I deal with multiple investment companies that would provide pricing for bonds, this means that I might have different pricing.
Absolutely. I mean,
which is not applicable to equities. In equities, the price of I'mar is the price of I'mar at any point of time.
Correct. So that's a positive and a negative. I mean, we trade between 400 and 500 different ISINs, and we're not always going to have exactly the same view as our competitors as to how we evaluate a particular credit. We may be better bid for some, better offered for others, but that's the that's the market.
Although the contract is exactly the same, the product is exactly the same, prices might be different.
Absolutely.
Okay.
It's the same as you go and buy a TV in a shop. It's the same.
Exactly.
It's the same item, but people have different pricing.
The difference between bonds and sukuk. We always hear if it is Islamic, it's sukuk. Technically speaking, what is the difference?
Sure. I mean, the main difference, as we all know, is that under Sharia law, interest is not something that's permitted. So the idea of a sukuk is that, and there are many different sukuk structures, but in all of them, the bonds will pay, or the sukuk will pay a profit rate as opposed to an interest rate. But for all intents and purposes, the profit rate will mimic that of an interest rate in a conventional bond. So the returns are the same, but it's just something that is permissible within Sharia law.
So the last question now, which I always ask to each of my guests. What, from your experience, which is a very, very long experience in the investment industry, what is your advice to retail investors?
My advice is that there are, as I mentioned earlier, a tremendous amount of new credits coming to the market. So fixed income instruments offer tremendous diversity. So, for example, EMAR have shares, as we know. I think the last time I looked, the dividend yield was something like 3%. Very volatile. You could be an investor, for example, that still has a very strong view of the Dubai property market, but you don't like the volatility of the shares. EMAR also have a 2-3 year sukuk, which trades at a yield to maturity of above 5%. So what I would urge is that rather than have all of your eggs in one basket, to look at which fixed income instruments are out there. Don't be put off by the perceived lack of liquidity, because they're becoming more and more liquid as the size of the universe gets bigger. And look at diversifying your portfolio, because there really are some tremendous opportunities to be had.
That's a new opportunity that people might learn at school or university, but when it comes to real life, they forget it. They always say shares, real estate, shares, real estate. Today in BHM Capital, we're also opening a new door for our investors to diversify the investments by adding a new product, which is fixed income. Thank you for today. Thank you for your time. We're going to have more episodes in FinTalk, and we'll always need your experience. So thank you for your time.
Thank you.
As we always say, we will always have more episodes. Thank you for watching. Have a good day.